So what these guys did then is they highlighted 10 high-level principles of consumer financial protection. We haven't got time to go through the 10 principles, but principle 3 is interesting. All financial consumers should be treated equitably, honestly and fairly at all stages of their relationship with financial service providers. Treating consumers fairly should be an integral part of the good governance and corporate culture of all financial services providers and authorised agents. And of course they mention again that special attention should be dedicated to the needs of vulnerable groups. And what they mean by vulnerable groups is those people who don't really understand what they're buying. And those people in some jurisdictions may form, in fact, the majority. So, treating customers fairly. Now, this is an interesting phrase, and actually what we're going to do very quickly now is look at the G20, the OECD, the UK's FSA and the MFSA. So, the UK FSA started work on TCF as far back as 2006, which is before anything had come out of the G20 or the OECD, because there's such a predictive bunch of guys at the UK's FSA. So basically, I mean, just going through this very quickly, so we don't want to sort of go over. What they wanted was consumers can be confident that they are dealing with firms where the fair treatment of customers is central to the corporate culture. So basically what we were trying to get to in the UK at this point is to actually get a situation where we got the consumer with a degree of confidence, basically, that they're actually going to be dealing with people who were going to treat them in a fair and reasonable manner. Because at that point in time in the UK, there was a general perception that that wasn't going to be the case. And they got these 6 outcomes. We haven't got time to go through them all now, but I mean, they're there and they're in the notes. And basically what the FSA said at the time was that as a result of dealing with the implementing these procedures in TCF, basically, we would get to a situation where consumers could be confident that those 6 outcomes would actually become a reality. So what about TCF in Malta? Because that's basically what we're interested in here today. Well, oddly enough, there was a half-day seminar at the MFSA's offices earlier this year in April, and the second speaker was Jeffrey Bazzina, who you will all know as a director of the MFSA. And basically what he was talking about was treating customers, treating clients fairly. So this is already on the agenda of the MFSA. It's already come to Malta, it's already here, and from unfortunately we didn't have the time to go through all the policy documents of the G20 and the OECD, and how that's filtered then through Brussels, and how that's coming soon to a regulator near you. But basically, this is very much part of the MFSA's agenda already, and in my opinion, from what I've seen in other jurisdictions like the US and the UK, and Ireland as well to a large extent, this will just get bigger and bigger and bigger. So it's as well to be aware of it, because it's not difficult through the likes of people like Adam to actually implement systems now that will almost head this off at the pass. You can actually build systems into everything you do in terms of board meetings, in terms of investment committee meetings, in terms of the way the advisors like the reports, that will actually build this all in quite easily and actually quite painlessly. And when as it becomes a bigger thing, you'll actually be in a position to say, well, yes, we know about that. We've already done it. We've already got it covered. It's better to preempt it than it is to be forced to do it. Because if you're forced to do it, it's often done with a very big stick, whereas if you preempt it, and it's not a difficult thing to actually incorporate in your systems, we may not ever get to the phase where the regulator comes at us with a big stick. So transparency of offering, ethics in asset management from a marketing perspective. I mean, all this is about really. Principle 4 of this is basically just say what you mean and mean what you say. I mean, if you're selling, you know, as I am, if you're selling this fund, I mean, I sell equities. I'm an equity manager. I'm not a bond manager. I don't do guaranteed products. I just manage equities, and equities go up and down in value. So there's no point in me trying to present to any client anything other than equities are volatile, because equities are volatile, and that's the end of that. So basically, what principle 4 is, just tell the truth. If whatever you're trying to sell is fine, but if you're trying to sell something that's risky, then just say it's risky. Explain to the client what the risk is versus the reward. You don't have to ignore the reward. The G20 and the OECD are not saying don't tell anybody you know, the yield's 10%. If the yield is 10%, fine, the yield's 10%. But at least explain to people what risk they're taking to generate the yield of 10%. Are the expectations in the sales process reasonable? You've got to ask yourself, of course. I saw an advert on the Daily Telegraph today with a very smiley Australian girl, and the little headline was, I've supplemented my income by dealing in FX. And, but there wasn't any advert underneath from some old lady saying, I've lost half my life savings by dealing in FX. Because what you're trying to do, of course, there is present a very rosy image in that advert, but not necessarily to actually say, but there is, hey, there is actually a downside here as well. Volatility and liquidity. Unfortunately, volatility and liquidity are best friends. You can't have liquidity in a market without actually creating volatility. Now, you know, your house, the price of your house isn't very volatile. It doesn't sort of go up and down every day. You don't sort of get up every morning and think, oh, I lost 2,000 euros last night, and sort of come home from work and think, I've made 3,000 euros today. But on the other hand, it's not very liquid either. It's going to take you a while to sell it if you want to. So unfortunately, because there's this obsession with liquidity, which isn't, in my opinion, always that well placed, we're going to have a lot of volatility. So you've got to explain to clients as well, particularly in a daily priced fund, which is what I'm involved in, that, you know, the price is going to change every day, and sometimes that change isn't going to be very pleasant. So investor sophistication assessment. This is based on UK FSA outcome 2, and again, basically what the G20 were talking about. And what we're sort of looking at there is, as James mentioned, you're keen to, when you launch a fund, to get as much money into the fund as you possibly can, and that's obvious, and it's perfectly understandable anybody should want to do that. But obviously, what you've got to ask yourself is this fund suitable for this investor? So you've got an investor who says, well, I'm really sort of quite cautious. I haven't really got that much money. Okay, what would you think I should have? Oh, I think you should have an innovation fund invested in new technologies in the US and benchmarks NASDAQ. Well, no, you know, I mean, that doesn't work, does it? So you know, I mean, this isn't asking for rocket science, it's asking really for common sense. PIFs versus UCITS, we all know, don't we? We've all been involved in the, they call them UCs, unauthorised collective investment schemes in the UK, PIFs in Malta. You've also got private funds in the Caribbean, etc. It's a lot easier to run a PIF than it is to run a UCITS from a compliance point of view and from all the terms point of views, etc. But obviously what you're saying with a PIF, what we're all saying if we're selling PIFs is that the client is in some way qualifying to buy this. It's not a retail fund, and we're saying the client is, for whatever reason, either because they've got a lot of money or because they're very clever, actually suitable as a person to buy this fund. And I think we need to be very careful that is actually true. Because I think one of the things, and Adam alluded to this as well, the regulator is going to become much, much more interested in, is this person genuinely a sophisticated investor? Genuinely, do they understand it? What have you got? What evidence have you got on your file that tells me, as a regulator, this client actually understands what he's buying? So UCITS rules allow us to be very clever. We know that. UCITS 4 is coming in. Adam alluded to UCITS 5. We can do all sorts of wonderful things in UCITS, even though they are retail funds. But I have to say, I don't think there are a huge number of UCITS funds in Malta at the moment anyway. But even though we can be very clever, doesn't mean we should be. You know, you can leverage it, you can use loads of FDIs, and you can do all sorts of wonderful things. But I think you have to ask yourself, does the underlying investor actually understand what I'm doing? Does he understand about leverage? Does he understand about derivative instruments? And if he doesn't really, well, even though I can do this, do I really want to? So, you know, you've got to ask yourself the question as an asset manager and as a person who sits on an investment committee and as a risk manager and as a portfolio manager, is this thing actually in line with the mandate? Is this, you know, is this a suitable investment given the fund's investment objectives? And lastly, do we need to press the reset button? Because sometimes as an investment manager, sometimes as an investment committee member, and indeed as a portfolio manager, you've actually got to look at that portfolio and think, well, actually, for whatever reason, possibly through no fault of anybody's, that portfolio of securities has actually got completely out of kilter with that investment mandate. because that turned a few months ago, and then we did that, and then we sold a bit of that, and you actually look at it and think, well, actually, no, that does not actually match the investment mandate now. I actually need to press the reset button and actually rebalance this portfolio back to what it actually says in the offering documents, because I've sold it to people based on the offering documents, and what I need to do is manage it in line with the offering documents. And again, that comes back to treating customers fairly, because that's what the customer bought at the end of the day. And that's all I've got time for, so thanks for listening.